Hey, folks, this week on the Prereal podcast, we're joined by Tom Dunkel. He's the Chief Investment Officer for Belrose Storage Group. If you're interested in investing as an LP in self-storage deals, Tom has got a really sound strategy. We talk a lot about the safe pathway that they describe in great detail on their website. It's sponsor, asset, financials, exit. The reason I enjoyed this conversation so much is Tom is very much focused on education and teaching investors that you've got to look hard at the sponsor, not so much just the asset, but the sponsor. You know, I've seen over the years great properties get run into the ground by not so great sponsors, and I've seen not so great real estate perform beautifully with a great sponsorship team. So if you're interested in investing in self-storage, Tom Dunkel this week, it's a good episode to check out, folks.
Are you ready to bring your real estate game to the next level? My name is James Prendamano. I'm the CEO and founder of Prereal, and over the past 25 years, I've closed over $1 billion in transactional real estate. Each week, I'm meeting with outstanding investors, high-performing individuals, and visionaries operating in the real estate space. These are the people that are actually out there in the real estate game right now getting it done. This podcast aims at bringing anyone's game to the next level. This is the Prereal Podcast.
Welcome, everyone, to the Prereal Podcast. We're joined today, folks, by Tom Dunkel. He's the Chief Investment Officer over at Belrose Storage Group. Belrose has put together over the last couple of years several 100,000 square feet in the self-storage space. And something that I thought was interesting and I wanted to touch on today, folks, is an acronym SAFE that Tom talks about quite a bit in his literature. And it's something that I think as LPs, we should be paying a lot more attention to. So with that, Tom, thank you very much for taking the time and joining us today.
Thanks, James. It's great to be with you and the listeners.
Yeah, no, it's a pleasure. I mean, anytime we can have someone on the show that has significant background and is undertaking one of these specific typologies like self-storage, it really is a highly specialized field. Over the years, we've seen a lot of these smaller funds diversify and dip their toe in waters that on paper look outstanding, but if you're not really an expert in those areas, when you get into these kinds of markets, you can have a bit of a tough go in it. So really appreciate you sharing your knowledge with us today. Why don't we spend a couple of minutes, if you don't mind, Tom? Let's go back and give the audience a little bit of history of how you ended up where you are today.
Yeah, sure. So thanks again. Yeah, I'm Tom Dunkel, Chief Investment Officer here at Belrose Storage Group. And I've been I was in corporate America, left corporate America about going on 17 years ago. Man, time flies. But if you do the math, I left corporate America and it was 2006. So went into real estate. It was something I had always wanted to do. Had a great run in corporate America doing mergers and acquisitions and corporate finance stuff. So I loved doing deals and raising capital. And so I thought I would just go and do that on my own. And, it was going to be easy, right? Because I had a, MBA from a top school and had this great background with, working with some incredible people. But of course, went into real estate 2006. My timing probably couldn't have been worse. And so proceeded to get my butt whooped those next few years. And crashed and burned and have those battle scars to show for it. But had to reinvent. So around 2009, I started learning about distressed mortgage debt and connected with my partner, Joe Downs. We've been partners 13 years now. And so we started a distressed debt company in 2010, and we were able to grow that. And it was a great business, but it's a very volatile business and it's a very unpredictable business. So it was hard for us to, especially me, kind of being, a little bit academic minded, MBA, all that, I wanted to, figure out, what's the business plan? What are the metrics we should be tracking? What are the KPIs and those kinds of things? And we just weren't able to do that in distressed debt. Now we had a successful business despite that, but along the way, we wanted to find a business that we felt had some longevity and we could build a team and build a business plan and, climb that mountain. And so we looked at hard money lending. We looked at fixing and flipping residential properties. We looked at title company. So we tried out a bunch of different things. But when we found self-storage, that's when the light bulb really went off, because, of course, it's a real estate asset. It's in commercial real estate, which, of course, the value there is driven by net operating income. It's a highly fragmented, dislocated kind of market, because you've got the big guys that you've heard of, Public Storage, Extra Space, et cetera. But what a lot of people don't realize is that those big guys only control about 25-30% of the self-storage market. So really, 65-70% of the market is more moms and pops, or like smaller regional players. And so there's a lot of really mismanaged self-storage facilities out there. And so that really caught our attention as business operators, wanting to get in there and leverage technology, leverage our team and their backgrounds and their expertise. We really saw it as a target-rich environment to build a really nice self-storage business.
Right now, it's like the most exciting time, I think, to be in real estate, if you understand those components of it, because there is just this whole universe that is still figuring it out on the fly. And when you're able to adopt these new strategies and build them into the program with relative efficiency, it does give you a real advantage, man.
100%, and that's something, James, and you're wise to point that out, and that's something that we're certainly exploiting, because a lot of the, of course, the big companies, they're kind of playing their own game, but they do take on a lot of overhead. They have full-time managers. They've got all the fancy stuff going on at their facilities. Our facilities are very plain vanilla. I tell people all the time, hey, we've got metal boxes on concrete pads and roll-up doors. It's not a complicated business, but we can still come in and apply technology to this industry. And where that shows up and why this is important for investors is we're able to really drive down our operating expenses. So I know a lot of people are interested in multifamily. I've actually been a multifamily investor as an LP myself since 2013. So I do know and really like that industry. One place where self-storage, I think, has a market difference is in that operating expense area. So if a multifamily facility, or even like a big public storage type facility, their expense ratio is going to be, for every $100 that they bring in of revenue, their expenses are going to be $60-70. It's going to leave $30-ish to go to the NOI, and which of course goes to pay debt service and investors. Well, ours is the inverse of that. Our expense ratio is typically in the 30% range, maybe a little higher on smaller facilities. But one of the facilities that we were able to exit last year, James, we were able to drive the operating expense ratio down to 18%. And that was because we leveraged technology, and we had a kick butt manager who we use a hybrid management structure because we're able to leverage technology. So we don't need a full-time person there. So we're able to drive down those expenses, pumps up the NOI, and we had a really nice exit there and delivered some great returns to our investors.
When you have such an incredible just bogey that is hard to identify and constantly changing in the legislative risk, and self-storage, while it has some, it is pretty well insulated. That's not the focal point of most of the legislation we're seeing coming out of Albany and the city. And I wonder, was that a part of your analysis as you picked self-storage?
Oh, sure, James. It was definitely on the probably the top 5 or so list of benefits we saw in self-storage. Is it's not governed by landlord-tenant law; it's governed by lien law. So when a tenant goes delinquent, there's a very clearly defined period of time. It's typically, it varies a little bit state to state, but typically it's 60 days. If they're delinquent 60 days, they get a notification, hey, your stuff's going to auction in 10 days, and bing, bang, boom, we can auction that stuff off. And then whoever wins the auction, they have a couple of days to clear out the unit. and then we just get it broom swept, and we can get it up and rented a lot of times later that same day.
So as just for the benefit of the audience, I want to spend another minute on explaining why in an inflationary period, self-storage is such a killer model. As that upward pressure is driving costs up. And look, folks, we've all felt it, right? We felt it at the pump. We felt it at the supermarket. You're able to recast on your vacant spaces or any spaces that are not under agreement, the asking prices to be reflective of the inflationary marks for that month, even if you wanted to. Theoretically, it could be for that day, but that might be a bit cumbersome to manage. So as inflation is driving prices up, you're not stuck in those fixed rental amounts. You're able to recast and enjoy that run up. So you decide self-storage is the place that you're going to live. It's an easier thing to model than the defaulted notes for sure. Can you walk us through, like day one when you've made the commitment? Okay, it's going to be self-storage. What's the first thing that you do? Where did you start?
Sure. Yeah, it's a great question. And yeah, I love you're highlighting a lot of the great things about self-storage. But really, James, having been in business for a while, by the time we ran into self-storage and wanted to make a run at it, we knew we had to do a couple of things up front before we got out over our skis. Was number one was we had to get educated, right? So we're pretty smart guys. We've been around the block a few times, but still, self-storage was a different asset class for us. So we went and got educated. We went to the conferences. We've done the academies and we're part of a self-storage mastermind group since 2019. So we really wanted to just immerse ourselves in the industry. So we went to the industry events. We joined the Self-Storage Association for our state and other states, and so we just really jumped right in and immersed ourselves. And in that process, James, we realized, hey, you know what, we've got a kind of a good starter kit for the team, but we don't have all the pieces that we need to really go and do what we want to do with storage. Because my partner Joe and I, we're deal guys, kind of like you mentioned earlier, deal junkies. So I've been doing deals my whole career. I'm the numbers nerd, so I run the spreadsheets and then I do the projections, do all the sensitivity analysis, and then run that up against our investors and get their feedback and such, and arrange for the financing. And so that Joe and I, we've done that in multiple industries. But the one thing that we weren't good at was finding the off-market deals. So to generate those leads, we really needed to go out and find that component. So through our self-storage mastermind group, we were able to find Tim Kane. So he's our third partner in our self-storage business. And he's an expert at not only the lead generation so that we can find the off-market deals, which are the ones that everybody wants, but he's also experienced in development. So to the extent we acquired a facility where there was additional space to either add on new units, or in the case of a facility we're looking at right now down in Georgia, there's a warehouse on the property that's just kind of full of a bunch of random junk. So what we're going to do is we're going to clean that out. We're going to convert that warehouse into temperature controlled storage. So he has that experience as well. Now, of course, James, you've been around the block as well, but it's pretty easy to buy real estate, right? If you pay cash, close tomorrow, and pay asking price or better, right? You can buy as much real estate as you can get your hands on. The problem is now you got to operate the thing, right? So that was the last piece of the puzzle for us, was we really needed to get that operating expertise in-house. So we hired Catherine East. She's now a 17-year veteran in the self-storage industry, former executive director of the Missouri Self-Storage Owners Association. And she's done transition and operations management consulting work and auditing work on storage facilities all around the country in our tier of the market, right? She's not working for the big boys. She's working on kind of the smaller, middle to lower tier facilities that fit our model. So when we brought her in, that's when we knew, okay, now we are ready to rock and roll. And so that's when we acquired our first facility. We didn't acquire our first facility till August of 2020. So it was about 2 to 3 years after we really started diving into the space. And so getting educated up front, getting the team together, also allowed us to line up the capital. So that's why we've been able to acquire 12 facilities in a little over 2 years.
You've got a good team. You're working on lead gen, because a healthy pipeline is everything in this business.
Right.
Was the focus going to be the mom and pop sites that could use technology and be repositioned? Were you interested at all in ground up development? What was the focus?
You opened up kind of an interesting topic, which is the cycles that we've been through. We kind of glossed over my corporate background at the beginning, but I'll just throw out that I joined a technology investment bank in 1999. So I lived through the internet bubble and was a part of that as well. So it's like you mentioned, James, it sounds like both of us have been through a little bit here and there. And for sure that paints, gives us a little different lens to look through when we are looking at real estate deals and real estate businesses. So 100% have that DNA. But yeah, we very similar, James, to multifamily, right? When we're looking at opportunities in self-storage, we're looking at we look at the market, right? So we want to see that the population's steady or growing. We want to see that, there's a decent level of income in that market. We want to see, low crime, low poverty, those kinds of things. We want to see jobs are steady or growing. We want to see infrastructure investments being made. So that it's a robust and diversified economy there. It's not a one factory kind of town, right? So we're looking at that. It doesn't necessarily have to be a super hot market, where everything's going through the roof. I mean, that certainly helps and is attractive. But we just did a deal in upstate New York in Carmel, actually, which is just a solid, basically a suburb more or less of Danbury, Connecticut, and certainly not a super hot growing market, but man, it's steady, really solid income there. Low crime and low poverty. And I'll tell you too, there's not enough storage up there. So that, of course, is the other thing we look at is what is the supply, we call it the supply index for storage. So the supply index is simply the amount of self-storage square footage in that market. We divide that by the population, and that gives us a square feet per capita in that market. So it varies different markets here and there, but generally speaking, about 8 feet per person is equilibrium. And so if we go to a market and we see that it's 18, 19, 20 feet per person, and we're gonna have to take a little extra look at that, because it sounds like that market might be oversupplied. It's not a black and white thing. But in the case of Carmel, New York, it was like 2 feet per capita. And so we're like, okay, wow. And when we do our next layer of due diligence, when we're actually contacting the facilities in a 10-mile radius, they were all full. So we knew that there's low supply and there's high demand. So what does that tell you? We can push rates. And so we can push rates until we, kind of see that, I guess, pain point, if you will, where the customers are starting to leave the facility. But in an area where incomes are pretty high and self-storage is scarce, and you can kind of boil that frog slowly over time, or quickly if you want, and you can really kind of put the customers in a position of, well, am I really going to have to empty out all my junk and try to move it somewhere to save $25 or $50 a month, or am I just going to kind of grin and bear it, sort of thing?
So I'm curious, and thank you for that background. Those are some great metrics. You had talked about a lot of the metrics, as you had highlighted, that are ones that we look at when we're considering a multifamily investment. In the tourism, is tourism or one of these lake towns have you found that has a big effect on the storage market?
It's certainly a more specialized kind of market. And we do have a facility in Cumming, Georgia, which is near Lake Lanier, which is a resort kind of area. So I guess that, there are folks there that are, they have vacation homes, or they have their boats or their wave runners or what have you. And a lot of places, a lot of neighborhoods, they don't want you to keep that stuff on your property. So that's where storage comes into place for boats and RVs and trailers and that kind of thing. So it is a little different kind of market. There are also, we own a facility in Lynchburg, Virginia, which is a college town. So we tend to get some seasonality there related to the college kids moving in and out. So it seems like every market, James, sort of has its own dynamics a little bit. And some markets are heavily contractor driven. So they like to have bigger units. So we do look at the customer base. And so when we do an expansion, for example, we say, hey, we need more 10 by 20s because contractors like those bigger units because they're storing their equipment or, their extra supplies or what have you, and they need that space. So we're definitely looking at all those things. But one of the things I absolutely need to touch on is when we are we talked about the market, but when we look at a specific facility, and these moms and pops are a lot of times, unfortunately, they're kind of asleep at the wheel, right? And so you talked about inflation, James. So over the past couple of years, rates on self-storage units have gone up substantially, but these moms and pops, they're not really paying that close attention. They're a little asleep at the wheel. So next thing you know, their rates are like 20% below market, 25, 30, we've seen rates 35, 40% below market. So if all we do is go in and acquire that facility and push up the rates to market over time and, manage the expenses, it's going to be a really solid deal. But that's something that we run into more than you would expect.
Are you guys finding that, I'm wondering if like customer experience, so let's assume that we had two facilities in similar locations, but one has used technology to handle their logging in, their logging out, access to the facility, and there's automated responses, and there's VAs returning calls, and you're using all the things that I'm sure that you've incorporated in one way or another. And then the mom and pop that is not so focused on customer experience, does that matter in self-storage?
Oh, 100%, James. Yeah, 100%. So everybody these days, and it was even exaggerated even more so during the COVID pandemic, but folks like to do business these days on their smartphones, right? So if somebody's needing storage, they're gonna pick up their phone, they're gonna ask Siri, or they're gonna hit their Google button, they're gonna say self-storage near me, and so whoever pops up in those first few names on Google in the search results, they're very, very likely to get the business. And if you can have someone, if you can have the technology in place where you can click through on your smartphone and go ahead and rent your unit, fill out your application and your paperwork and sign it with your finger, and get your gate code, texted to you, so you can go to the facility at your leisure, get in the gate, you go to your unit, you roll up the unit door, and your lock is right there ready for you, and it's all swept out, ready to go. That's the convenience that we bring to the table with the technology that we put in place. And a lot of moms and pops, they might be lucky to have a website. And they might be lucky to have a management software system. So that's just what we do. That's just part of what we do. We implement the technology. We do the search engine optimization. We're doing all those cool marketing things. And in fact, on the gate at our facilities, there's a sign on there with a QR code on it. So you can take your smartphone, you can take a picture of the QR code, and just right there while they're standing at the gate, they can fill out their paperwork, get their gate code, and they can enter the the facility. So we have all of that in place, which again, it's just that convenience factor, right? Because people these days, they like convenience, they like that immediate gratification, that they're not calling up and saying, oh, can I get my storage unit, next Saturday? They want it right now.
Yep.
And so those moms and pops, they don't have the website, you're lucky if they answer the phone. Because again, they're not running it really as a business. As a quick story, the gentleman we bought the facility from up in Carmel, New York, older gentleman, ready to retire, spent a lot of time in Florida, and he had built the place. He had his daughter working there as the manager, overpaying her, so their expenses were too high. And he told us, he's like, well, yeah, I know my rates are pretty low, but he's like, you know what, I'm happy with the amount of money coming in each month. I know a bunch of the customers. I don't want to rock the boat. I don't want to piss them off. And so he just continues on, and he wishes us all the luck in the world, because he knows what we're going to be doing with it. But that was his philosophy, was, hey, I'm happy with what's coming in. Customers are happy, so I'm happy, and I get to go to Florida and hang out with my young girlfriend and play some golf. So
you're touching on such an important thing that we don't spend enough time on when sourcing these deals, and it's the sign of a good sponsor, folks. If they understand that price, more times than not, is not the driving factor in a seller making a decision. They want to feel like they can take pride in what they've done. They want to know that this is going to live on. They want the deal to match the lifestyle. Oftentimes we have found this almost exact avatar of a seller that you're describing. Mm-hmm. They typically hold notes because they enjoy the revenue. There's a lot of opportunity there. Don't get hung up. And now, as the market's softening a little bit, it's not as relevant, but we'll be back there again, folks. When things are crazy and prices are going nuts, don't let your deal makers drive you down a path of just price. You've got to connect with your seller and find what's important to them and tailor your deal, as Tom is describing, to that lifestyle. I love that you knew that they want to be in Florida playing golf with their girlfriend and enjoying what they're doing. They've got connections in the local community, right? You can structure a deal that is not price sensitive, which for us as the new person coming in is paramount, right? But for them, it's not. And it's important we don't put our thought on the deal and our metrics onto our sellers. So I love the approach. And with that, I want to transition, because it's a simple acronym, but I love it. Can you speak a little bit about SAFE and what that means for you guys?
Sure, James. I'd love to go into that. If I can just touch quickly, you mentioned seller financing. So I didn't mention before, the same gentleman up in Carmel, New York, he actually provided seller financing on that facility, interest only, for 5 years at 5%. So, I mean, right there, that's a huge value add for our investors right there. So we're cash flowing from day one, and we're rocking and rolling there pretty good. But yeah, so
I've done this a few times, Tom, and it sounds like you have too. I love it.
That's right. Yeah, that's a beautiful thing. Yeah, so SAFE, James, came out of just my personal experience as an investor. I mean, first and foremost, I mean, look, we love self-storage. We've got a great business going here with storage. I love distressed debt and other asset classes. But at the end of the day, I'm an investor, right? I've been a full-time investor since 2006. And so along the way, as I was looking at different deals and different funds and who to back and asset classes and this and that, I had a great background, right, in corporate finance and running models and financial stuff. So I knew a lot going in, but I certainly didn't know everything. And so along the way, I made a ton of mistakes, right, as I was looking at different kinds of deals. And so I thought it'd be valuable to provide a resource to investors that were in my same shoes back then, so that it gives them a due diligence framework, right? So that they can get started. So that I'm thinking about, the busy professional out there, the lawyer, the doctor, the consultant, or the sales guy, or, whoever it is that's, they they've got some money coming in, they want to put some money to work, they're a little concerned about the stock market or digital currency, whatever it is. But they see value in what alternative investments, which don't get me even started on how it got named alternative investments. I mean, what's more basic than, real estate and lending? I mean, it goes back to biblical times. Anyway, don't want to get on my soapbox there. But so we came up with this framework for busy professionals so they could do their due diligence and they could take that step out of the public markets and into alternative investments, because I realize it's a daunting step, right? You're not really sure where to start. You see that there's value in alternative investments and real estate and getting with the right sponsors, but you're just not really sure how to do it. And so SAFE, James, is an acronym. We've turned it into an ebook that's available on our website for free, and it's an acronym, SAFE. And certainly, please don't anyone come to me and say, "Oh, you're saying investing is safe." No, investing is not safe. Investing has a lot of risks. However, if you use the SAFE checklist, it can help to eliminate some of those risks. So S is for sponsor, A is for asset, F is for financials, E is for exit, right? So the checklist gives you lots of questions to ask, right? So S for sponsor, who's running the deal? What's their background? Have they been successful? Have they how long have they been in this asset class? Have they generated, returns? Have they had a full cycle, right? Have they purchased a property, done what they said they were going to do, and then exited, right? So, in fact, James, you might have run into this as well, but we have a investor we've worked with for years. I mean, he's a 9-figure guy, 9-figure net worth guy, and so very, very, wealthy. And he said, pretty much more than anything else, he's looking at the sponsor more than a lot of anything else, because that, in his experience, he's found that that's where a lot of his deals have gone wrong, is he didn't have the right sponsor. So go through the checklist, ask all the questions, and at the end of the day, James, the question for the investor is, can I sleep well at night knowing this guy, this company has my hard-earned money, right? And then you go to A. A is for asset. So I'm surprised sometimes when I talk to investors and they can't really tell you what it is they're investing in. So the A section, the A for asset, right? It's what is it exactly that you're investing in? If you invest with Belrose Storage Group in one of our self-storage deals, you're buying membership interests in an LLC that owns the property. So you're not buying directly into the property, buying into an LLC. I would love for someone to tell me, who's investing in digital currencies, what is it that you're investing in? Can you explain that asset to your children? So just, series of questions about that. Where is the asset? What market is it in? How do you feel about that market? What is it, a growing market? Is it a solid market? Those kinds of things. F is for financials, right? So financials is, what do the projections look like? Are they believable? Has the sponsor delivered on these kinds of projections in the past? And then also for you personally as an investor, how much of your net worth or liquid resources is this investment taking up? And are you okay with that? And again, the ultimate question with all these sections, James, is can I sleep well at night? Understanding the sponsor, understanding the asset, understanding the financials, and ultimately the exit. E is for exit, right? So how do I get out of this thing? I can't go to schwab.com and click, sell my position in a Belrose self-storage deal, because it's just not set up that way. So as an investor going in, you need to be comfortable understanding that your capital is going to be tied up for 2, 3, 4, 5 years, depending on the particular characteristics of that deal. And you need to know, has the sponsor exited that way before? So if they're saying, hey, we're going to sell the property, what's that look like? Who's going to buy it? When is that going to happen? And are you sure we can sell at a price that's going to be profitable? And then there's all kinds of other considerations with the exit. And I would say that tax implications. What happens when you sell and you get that money back? Is that going to be taxed, and how? So there are all those kinds of questions. So I think it's a checklist. It's meant to be a workbook that folks use and they write on it and scribble down. And And I would say too, like I feel like investors, like they meet somebody like, oh, hey, you know, Tom's a good guy. I'll throw him 100 grand or 200 grand, whatever. And I appreciate that, but you know, you should really take that opportunity to ask me the hard questions, you know, and get to know me and my company and my team. And the fact that you're writing that check or, you know, for that money, I mean, it gives you the right to ask those questions and you know, really dig in. And I encourage people to do that. I know sometimes it can be a little uncomfortable, but I think that's why the checklist helps, is because if you're just on the phone with the sponsor and you're just reading down your checklist, it makes it a lot easier to ask those tough questions as opposed to, you know, just coming up with it off the top of your head. But I encourage folks to use that as a way to de-risk and take that step into alternative investments. Because I think for me personally, as an investor, full-time investor, the past going on 17 years, you know, I love alternative investments. I think it's the way to go. I wish it was more widely adopted by folks out there. I think there would be a lot more people that were in a more financially secure position if that were the case.
Tom, can we spend just a couple of minutes before I let you go on the investment itself? What are targeted returns look like? Are these blind pool investments, or are they on? Is it prescribed what assets the LLC owns at the time of investment? How long of a tie-up period is it? If you could just hit 2 or 3 of those points for us.
Sure, James. Yeah. So we're a direct investment shop. So investors that are in our deals, they are investing in a specific property that has a specific strategy associated with it, including the timeline to exit. So some of our deals as value add, you know, we're able to get in and turn them around pretty quickly. So that's usually going to be around a 2, you know, maybe 2.5 year deal. Other deals that have some more moving parts, like the facility we're about to acquire in Georgia, you know, there's an expansion component there, conversion. So that one, we're giving ourselves a 4-year runway, 4 to 5 year, just because of the conversion, construction, lease up aspects to that deal. But yeah, our investors come in and they come in as Class A investors. Our minimums are 50,000. We have investors, our average is about 100 and 110, give or take. And we have some investors come in, you know, 250,000, et cetera. But our investors are typically, you know, busy professionals that love what we're doing, but don't have the time or the expertise or the inclination to go do it themselves. So we're happy to be able to provide that service. But our investors receive a monthly distribution once the property is up and running and cash flowing. They receive a monthly distribution as a preferred dividend, which is cumulative. So it's meaning that if we don't, so the deal we have right now is in the 8% pref. If we don't hit the 8% in the first year, which in this deal we won't, because we do have that conversion component, we'll make up for it later. And our projections are showing that we'll be able to do that in year 2 and 3. We'll be able to catch that up. Because once we get the facility converted and up and running, you know, we're going to be, you know, cash flowing really strong. And then there's a profit split at the end once the property is sold, and then that profit split plus getting the capital back to the investors. You know, we're targeting, James, the high teens, you know, 17, 18, 19% overall annualized return to investors. Over, you know, like I said earlier, like maybe a 2-year time frame or up to a 4 to 5 year time frame for a more complicated project.
Wow. Is there any room in the cap stack for folks that have self-directed IRAs?
Oh, absolutely. Yeah. Yeah. I've been a self-directed IRA investor since 2009. So I'm a big fan of the self-directed IRAs, and we have them in our deals, I think pretty much every time.
So Tom, what's the best way for folks to reach out if they're interested in investing and they want to learn more about the company? Where can we point them to? Yeah,
sure, James. This has been great. Tom Dunkel, I'm Chief Investment Officer at Belrose Storage Group. You can find us at belrosestorategroup.com, where you can register in our investment portal. And our investor portal is where all of our deals are posted and our communications are made. And it's a pretty slick back end. That's where the tax documents live, and that's where the distributions are made out of. And so it's all very streamlined, which is great for us, and it's great for our investors as well. But yeah, we're excited to be on a nice growth path here in a great asset class, and we are excited to have a great team, and we have lots of resources. We try to put a lot of value add resources out there, James, for our potential investors. So we have a Facebook page, belrosestoragegroup.com, where you can see some of my other podcast interviews, other articles and blogs that we write up about, what we're seeing in self-storage, why we like self-storage, little blurbs about the team and all those kinds of things.
Well, this was super informative, folks. As always, all the links will be below. Tom, Dunkel, really appreciate the time. Best of luck moving forward.
Thanks, James. Best of luck to you as well.
Thank you. As always, everyone, please stay safe.
Are you ready to bring your real estate game to the next level? My name is James Prendamano. I'm the CEO and founder of Prereal. And over the past 25 years, I've closed over $1 billion in transactional real estate. Each week, I'm meeting with outstanding investors, high-performing individuals, and visionaries operating in the real estate space. These are the people that are actually out there in the real estate game right now getting it done. This podcast aims at bringing anyone's game to the next level. This is the Prereal Podcast.